Bitcoin remains volatile after hitting record highs earlier in 2025, while crypto markets shift towards tokenization and stablecoin adoption. Hi, everyone. I'm Jenny Horne, and this is Crypto Corner here on Schwab Network. With Bitcoin range bound in the high 80s and low 90s, this week we are going to focus on some of the stories that could impact the crypto industry moving forward. Joining us now to discuss some of the recent volatility is Adam Lynch, director at the Schwab Center for Financial Research. Adam, as always, thanks so much for joining us. What do you see as the biggest hurdle that could be delaying the crypto market structure bill as we head into 2026?
Yeah, I think the announcement this week from essentially the U.S. Senate Banking Committee announcing that they're not going to hold a crypto market structure markup hearing bill this month was somewhat expected, but it was still a little disappointing to hear. What it does is essentially pushes any progress towards new crypto laws into 2026. Now, a spokesperson for the committee said that in a statement that Chairman Tim Scott and the committee have made strong progress with Democratic counterparts. They want to make sure this is a bipartisan bill, right? But these lawmakers are still negotiating. So the market structure bill was intended to define how the SEC and the CFTC oversee the crypto markets, designating the CFTC as the primary spot market regulator and trying to more clearly define how securities laws could apply to these things. Now, while the delay was expected, it's in a little bit of a blow to the industry. We did want to see a little bit more substantial progress, right? So, what happens next, I think, is going to be what's most interesting. When Congress returns from its holiday break, their focus is likely going to be on funding the government because the current funding bill expires at the end of January. So, assuming that the government doesn't shut down again, lawmakers are still going to have a limited amount of time to try and work on this bill before next year's midterm elections become their top priority. Now, while some of the delay is seen mostly as negative, there are others, like Blockchain Association Chief Policy Officer Lindsay Frazier, who see this as more of a sign of robust bipartisan involvement rather than fading drive to get this bill done. And on a more positive note, coming from the world of regulation, the FDIC, which regulates thousands of banks in the US, issued its first proposal of a rule governing the application process for stablecoins. This is essentially the first rule proposal to emerge from the Genius Act passed earlier this year. Now, the proposal would affect institutions that want to set up subsidiaries for issuing the dollar-backed stablecoins. Interested parties would need to submit letters describing their business, including financial information, and essentially their plans for running a safe and steady issuance. The FDIC also said that more substantial rules will likely emerge in the months ahead, which will establish the capital, liquidity, and risk management requirements for such issues.
Okay, and what challenges could be slowing Visa's stablecoin settlement rollout in the United States?
Yeah, Visa's been a pretty interesting one the past week. Obviously, we just mentioned the FDIC proposal, but the signal from Visa was maybe an even stronger one, that these stable coins are moving deeper into the financial system. Now, what they essentially did this week was expand their USDC settlement program to US banks, enabling participants to settle using Circle's USDC on the Solana blockchain. What this essentially does is allow banks and payment firms to move funds outside of traditional banking hours. The framework aims to redefine the modern settlement process in a couple of different ways. First of all, with that 7-day settlement window, we no longer have to rely upon a 5-day business day window, for example. Modernized liquidity and treasury management is a big piece of this. That just helps with speed and accuracy. And then interoperability is another thing that they're aiming for here. For years, Visa has been active in the stablecoin development. They first experimented with USDC settlement all the way back in 2021, and they became one of the first major networks to have a settlement, a transaction settled in stablecoin in 2023. And then as of November, Visa's monthly stablecoin volume passed a $3.5 billion annualized run rate. So I don't think there's much that's going to slow them down. I think they're just going to continue to evolve in this space. We've seen firms like them essentially try and help out too by setting up consulting services. Visa Consulting just launched something called their stablecoin advisory practice. So I think we're going to see more and more of these issues coming out in the future.
Okay, and last but not least, the story we're looking at here is all the moves we've seen from JPMorgan. So, specifically are we seeing the firm's moves on Solana and Ethereum signal perhaps the next phase of institutional adoption for these tokenized assets?
Yeah, that's a great one. JP Morgan's had a very busy crypto related week. Last week, what they did is essentially arranged a landmark commercial paper issuance on the Solana blockchain. It's a big move which helps push the real world financial instruments into this public blockchain infrastructure. Now, if you're not familiar with corporate paper, or excuse me, commercial paper, what it is a short term debt tool used by companies to raise working capital, usually issued through old legacy systems. However, this issuance was structured on chain and settled using USDC. Galaxy Digital was the firm that issued the paper, with Coinbase and Franklin Templeton as the buyers, again, with this transaction settled in USDC. The move just underscores the rising institutional interest to use this blockchain plumbing for traditional financial instruments. This is tokenization, right? And the process of tokenization promises efficiency gains and faster settlement. Then this week, what JP Morgan did is stepped even further into the market of crypto with a tokenized money market fund, which simply enables investors to hold digital tokens which represent their ownership in this fund. Now, JPM seeded the fund on Monday with $100 million and opened it up to outside investors on Tuesday. The fund is called My On-Chain Net Yield Fund, or MONY, and it's open to qualified investors or individuals and institutions which meet minimum account size thresholds. Now, like most money market funds, Money holds a basket of relatively safe short-term debt securities that tend to yield more than the bank's deposits. These are attractive investments for crypto investors because they allow the holders to earn a yield while their assets remain entirely on the blockchain. Assets in money market funds are about $7.7 trillion, up from 6.9 trillion at the start of the year. So this just gives you an idea of how big this market is. Other firms like BlackRock, Goldman, Bank of New York are already offering or have plans to offer funds like this. So this type of tokenization is likely here to stay.
And I always think so encouraging when you see this backing from JP Morgan because for so long we know Jamie Dimon was one of the biggest critics of the overall space. So we so appreciate it, Adam Lynch, for all of that insight. And thank you all for tuning into this week's Crypto Corner. For more crypto content, remember to subscribe to the Schwab Network YouTube channel. That'll do it for us here. I'm Jenny Horne. We'll see you again next week.